Good afternoon. You're watching a special broadcast of the Reserve Bank interest rate announcement on SABC2. The bank's Monetary Policy Committee has been meeting over the past 2 days to decide on whether or not to move on the repo rate. Governor Jill Marcus is about to take the podium shortly. We will be crossing live to that venue in a short while. With me, Camilla Golder from ETM. She'll talk to us about that decision when we come back. But for now, let's cross over to that venue. Jill Marcus is at the podium.
At this stage, there are no discernible inflationary pressures coming from the demand side of the economy. The global recovery seems to have remained on track, but the unresolved European sovereign debt crisis, rising international oil prices, partly as a result of geopolitical events and the tragic events in Japan, may moderate the pace of recovery in the near term. Global inflation risks have also increased, particularly in the emerging market economies, a number of which have tightened their monetary policy stances in recent months. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, measured 3.7% in January and February. Food price inflation, while still low, has been increasing. In February, it measured 3.5% and contributed 0.6% to the overall inflation outcome. On a month-on-month basis, food prices declined by 0.1%. Housing and utilities, primarily electricity, contributed 1.5 percentage points to the outcome. Petrol prices increased at a year-on-year rate of 12.3%, while administered prices, excluding petrol, increased by 9.1%. CPI inflation, excluding administered prices, was unchanged at 2.7%, while CPI inflation, excluding food and petrol, measured 3.4%. Year-on-year producer price inflation continued its recent downward trend in January, when it measured 5.5%, compared with 5.8% in December 2010. Food price pressures remained relatively subdued in January, despite marked increases in global food prices. Manufactured food and agricultural prices increased by 1.5% and 0.5% respectively. This suggests that food price increases at the consumer price level may be moderated in the near term. The trajectory of the CPI forecast of the bank has changed somewhat since the previous meeting of the Monetary Policy Committee. Nevertheless, inflation is still expected to remain within the target range over the entire forecast period. Inflation is now expected to average 4.7% in 2011 and 5.7% in 2012. This represents an upward adjustment of approximately half a percentage point in both 2011 and 2012. Inflation is expected to peak at 5.8% in the first quarter of 2012, before declining to 5.6% in the fourth quarter. The upward adjustment is mainly due to revised assumptions regarding the international oil price over the forecast period. The survey conducted by Reuters also reflects a moderate upward adjustment in the inflation forecasts. In the February survey, the mean forecast of CPI inflation increased by 0.2 percentage points to 4.7 for 2011 and by 0.4 percentage points to 6% for 2012. Inflation expectations for 2013 remained more or less unchanged at around 5.7%. The break-even inflation rates have increased to above the 6% levels over the longer-term maturities. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the first quarter of 2011, also indicate a slight deterioration in the expectation of financial analysts. However, there was some improvement in the expectations of business executives and trade unionists. Inflation is now expected to average 5.3% in 2011 and 5.7% in 2012, compared with 5.5% and 6.2% in the previous survey. Inflation is expected to average 6% in 2013. While all categories of respondents expect inflation to remain within the target range in 2011 and 2012, business and trade union expectations average 6.2% in 2013, compared with 5.6% for financial analysts. The global economic recovery, although uneven, is expected to continue, led by a strong performance in global manufacturing. However, significant downside risks remain due to the confluence of shocks that have had the potential to stall the nascent recovery. These shocks include higher international oil prices, driven in part by events in North Africa and the Middle East, and the recent disasters in Japan, which could have a negative impact on the global manufacturing supply chain. The sovereign debt crisis in the euro area remains a concern, with CDS spreads signaling increased risks of sovereign debt defaults. The US outlook appears favorable, but the weak housing market and the ability of the economy to sustain growth once the fiscal stimuli dissipate during the year are some of the risks that persist. Growth in emerging markets remain robust, but Asian economies in particular may be negatively impacted by the recent developments in Japan. The global growth outlook may also be dependent on the extent to which the authorities in China manage to slow their economy down. The global inflation outlook has also deteriorated somewhat in the face of higher oil and food prices, although in some of the advanced economies there is a marked divergence between core and headline inflation. This reflects the relatively weak underlying demand conditions and the generally accommodative monetary policy in these countries. In the faster-growing emerging markets, inflation pressures are more pronounced and monetary policy tightening has become more widespread. The strong capital inflows to emerging markets that were a feature of most of 2010 have slowed down and in some instances reversed. South Africa has also experienced net sales of bonds since November, and in the year to date, net sales of bonds and equities by non-residents have amounted to 19.2 billion rand. Despite these net sales and the continued purchase of foreign exchange by the bank, the rand exchange rate has remained firm but volatile. The rand exchange rate is relatively unchanged since the previous meeting of the MPC, but has fluctuated between 6 Rand 80 and 7 Rand 33 per dollar per US dollar during this period. Part of the recent strength of the rand can be ascribed to US dollar weakness. During this period, the US dollar depreciated by almost 5% against the euro, despite rating downgrades in a number of euro area countries. Since the previous meeting, the rand has depreciated by over 3% against the euro and by about 1% on a trade-weighted basis. Domestic growth prospects appear to have improved moderately. Real gross domestic product grew by 2.8% in 2010 and at an annualized rate of 4.4% in the fourth quarter. The forecast of the bank has increased somewhat since the previous meeting of the MPC, with GDP now expected to average 3.7% and 3.9% in 2011 and 2012 respectively. These growth rates, while an improvement, are still too low to have a significant impact on the unemployment rate, which measured 24% in the fourth quarter of 2010. According to Statistics South Africa, formal non-agricultural employment increased by approximately 65,000 jobs in that quarter. The more favorable growth performance was driven mainly by the mining and manufacturing sectors. A number of high-frequency indicators suggest that the growth momentum will be sustained. The composite leading business cycle indicator has maintained its positive trend, and the Kagiso BER Purchasing Managers Index has remained above the neutral level since November 2010, suggesting a favorable outlook for the manufacturing sector. The physical volume of manufacturing production increased at a moderate year-on-year rate of 1.3% in January, but the 3-month-on-3-month rate increased by 2.8%. However, output levels are still below those achieved before the crisis, and the sector remains characterized by underutilized capacity. The utilization of production capacity increased from 79.2% in the third quarter of 2010 to 80.7% in the fourth quarter, compared with a pre-crisis average of around 85%. Output in the mining sector has maintained its general upward trend, notwithstanding the 1.9% month-on-month decline in January. Reflecting these developments, the RMB BER Business Confidence Index increased significantly in the first quarter of 2011 to reach a level above neutral for the first time in 3 years. The building sector was the only sector in which negative sentiment was recorded. This is consistent with the quarter-on-quarter decline in the real value of new building plans passed in the fourth quarter of 2010 and the persistently low level of the FNB Civil Construction Index. The domestic growth prospects will also be dependent on developments in gross fixed capital formation, which declined by 3.7% in 2010 and made a negative contribution to GDP that year. In the fourth quarter of 2010, an annualized increase of 1.5% was recorded. Capital expenditure by public corporations increased by 3.3% in the fourth quarter of 2010, while private sector investment, which declined by 4.4% over the year, grew at an annualized rate of 1.6% in the same quarter. The relatively weak capital expenditure growth contributed to the decline in imports, which, along with improved commodity prices, allowed for a marked decline in the deficit on the current account of the balance of payments to 0.6% of GDP in the fourth quarter of 2010. However, should capital expenditure pick up, as envisaged by the public corporations, the current account deficit is likely to widen. Real final consumption expenditure by households increased by 5.1% in the final quarter of 2010, indicative of continued positive consumer sentiment and positive disposable income growth. This category of expenditure made the largest contribution, that is 2.8 percentage points, to growth in GDP during the year. There are indications that although consumption expenditure growth will remain relatively robust, it is unlikely to accelerate to excessive levels in the short term. The FNB-BER Consumer Confidence Index declined in the first quarter of 2011, but still remains at a relatively high level. This was consistent with the decline in confidence, albeit from high levels, evident amongst retailers in the Business Confidence Index and the retail trade sales growth in January, which was below market expectations. Expenditure on durable goods, in particular new motor vehicles, has been strong. Consumption expenditure is expected to be constrained to some extent by the continued high levels of household indebtedness, which declined marginally to 77.6% of disposable income in the fourth quarter, and the further increase in the number of consumers with impaired credit records since the implementation of the National Credit Act. The ratio of impaired advances to gross loans and advances of banks has remained relatively unchanged at around 5.8% for some time. Bank credit extension to the private sector has remained subdued. Total loans and advances by banks to the private sector have been growing at an annual rate of around 4% since September 2010, driven largely by mortgage loans and general loans, mainly to the household sector. Growth in mortgage advances, however, declined from 4.8% in November 2010 to 3.8% in January 2011, reflecting the subdued state of the property market. The various house price indices all indicate that house prices are either falling or increasing at very low nominal rates. This, combined with the recent decline in equity prices, may contribute to a moderation of the impact of wealth effects on consumption. The recent national government budget tabled before Parliament indicates a moderately looser fiscal policy stance through a slower pace of fiscal deficit reduction compared with that in the October 2010 medium-term budget policy statement. The fiscal deficit is now estimated to decline to 3.8% of GDP by 2013-14 fiscal year, compared with the 3.2% in the medium-term budget policy statement. The government debt-GDP ratio is expected to peak at 43.1% in 2013-14, which is much lower than the internationally acceptable norm of around 60%. High real wage settlements have been a significant upside risk to the inflation outlook. However, there are indications that nominal wage settlement rates may be moderating. According to Andrew Levy employment publications, the overall average wage settlement rate in collective bargaining agreements amounted to 8.2% in 2010, compared with a rate of 9.3% in 2009. Similarly, the downward trend in year-on-year growth in unit labor costs continued into the fourth quarter of 2010, when it measured 7.7% compared with 9.3% in the previous quarter. This positive trend, if continued, may contribute meaningfully to attaining an environment of low inflation and employment creation. The biggest risks to the inflation outlook remain food and administered prices, in particular oil prices. International oil prices had already accelerated in the latter part of 2010 in response to strong global demand, and this upward trend has been reinforced by the geopolitical events in North Africa and the Middle East, which have raised concerns about the security of oil supplies. Should these political issues be resolved soon, the underlying demand pressures are likely to still keep oil prices at relatively elevated levels. Since the previous meeting of the MPC, Brent crude oil prices have increased by almost $20 per barrel. Domestic petrol prices have increased by just under R1 per litre since January 2011, and a further upward adjustment is expected in April, in addition to the increased fuel levy. The MPC is of the view that the risks to the inflation outlook are on the upside. However, these risks and underlying pressures are mainly of a cost-push nature. In the light of the above, the MPC has decided to keep the repo rate unchanged at 5.5% per annum for the time being. Given the significant upside risks to the inflation outlook, the MPC will closely monitor any indications of second-round effects on inflation emanating from these cost pressures. Thank you. That's the end of the statement. We can open for any questions. And obviously, as is usual, the questions may be answered by myself, but also by any of my colleagues.
Governor,
Sorry, just to remind you to introduce yourselves.
Helmer Price, The New Age. Governor, in the quarterly bulletin, the box showed that the impact of a $10 per barrel rise in the oil price over 4 quarters was a 0.6 percentage point increase. We've had a $20 per barrel increase, but the MPC forecast has only been increased by 0.5%. Do you expect, therefore, the oil price to come back down?
What we expect is that at this point in time, I don't think anybody really knows what's going to happen to the oil price. We obviously have looked at, and in terms of our numbers, put in the numbers that we anticipate at this point in time. So it's within our forecast. We have put in increased numbers for oil, and this is the outcome of our forecast. Obviously, what we're saying is that this is a huge risk on the upside.
Well, that was the Reserve Bank Governor Joe Marcus there, and as you heard, that repo rate remaining unchanged at 5.5%. Now, Camilla Golder is from ETM. She joins us now. Camilla, thanks very much indeed.
Thanks, Devon.
Before this MPC announcement, people said that, well, if the rates remain unchanged, we still need to watch out for perhaps a hawkish stance that the governor would portray. Do you think she was hawkish in her announcement today?
Well, she certainly outlined the risks to inflation, and they slightly increased their inflation forecast for this year and next year. But I got the sense it was a fairly neutral statement. I wouldn't call it very hawkish, although she did take care to outline the risks, which they'll continue to monitor going forward.
Mm-hmm. What did you think about the area of inflation? I want to get your answer, but let's just go out for a break, and when we come back, we'll take a look at GDP and inflation. We'll be back in a moment.
We're here to see how people react when they try new Colgate Sensitive Pro Relief. Now, what I'd like you to do is rub this new toothpaste where you feel the sensitivity. Now, drink this ice water.
That's quick. It works.
It's the Pro Argin formula that instantly seals the open channels to the nerves. With daily brushing, you get lasting relief. It's worked really quickly.
New Colgate Sensitive Pro Relief for instant and lasting relief. Prove it to yourself. Colgate, #1 brand recommended by dentists.
Thomas Tor, damage expert.
Most girls don't realise that they have damaged hair. I use a simple test. When your hair's damaged, it's full of cracks and holes. This makes it sink in water. I've been working with Sunsilk to co-create a new range of products for damaged hair. They reconstruct your hair in just 5 washes to make it look healthy again. And as you can see, healthy hair floats.
Try new Sunsilk now. New Sunsilk Damage Reconstruction by Thomas Tor. Now available in shampoo and conditioner trial packs. Now only £4.99 each.
Introducing the Smart Shopper card from Pick n Pay that earns you smart points every time you shop. Great value just got more rewarding. Get 9 2-ply baby soft toilet rolls for only $39.99 and get triple points. And assorted Axe deodorants for just $15.29 each and score another triple point reward. So get the card that rewards you for every rand you spend. It's our thank you to you for shopping at your favorite Pick n Pay.
Stay right where you are. Look at this. Who in the Izinyoga who made this connection for you?
Babusi said we could have our electricity for free.
Free? If you get shocked, you will pay with your lives. This ground is full of electricity. An unsafe connection is a death trap. Where's up? Who gives? We are pulling. The mobile generation.
Get this color screen Samsung E1070 for only $129. Or the Samsung E250 camera phone with FM radio for an unbelievable $379. Offers include an MTN starter pack activated in store. These fantastic deals available at Express stores, Discount pharmacies, Fashion World, Fashion for You, and these fine stores.
The mobile generation.
Closer.
Because dirt can happen fast, you need a cleaner that can keep up. New multi-purpose Handy Active Fizz. Fizzes on dirt right before your eyes. Spray and wait until it penetrates and watch it lift the dirt away fast. Handy Active Fizz fizzes dirt away fast. Sound good?
Welcome back. You're watching a special broadcast on SABC2, the Reserve Bank announcement of the repo rate, and of course Reserve Bank Governor Jill Marcus announcing that it remains unchanged, the repo rate at 5.5%. Now, Camilla Golder from ETN joins us to talk about that. Camilla, we were speaking before the break about whether or not the governor was hawkish, but I want to talk about the remarks she made about inflation. She says, well, one of the reasons why the rate is remaining unchanged is because the inflation is basically due to cost push factors. What does that mean?
Cost push factors are when it's not driven by consumers buying goods. So basically it's things like oil, administrative prices, food prices that are usually more global in nature. And so she did raise those risks to the inflation outlook.
What do you think about the inflation outlook for this year? I mean, she's given a few figures which you've jotted down for this year. Does it tie in with your thinking?
Well, the Reserve Bank has raised their forecast for inflation for this year slightly. And that's under the premise that oil's eventually going to start feeding through to higher consumer prices. However, at ETM, we see scope that inflation's actually going to moderate lower. And that is because consumers are still under pressure financially. They're still deleveraging, and credit growth has been extremely weak. It actually slowed in January, according to the most recent figures. And higher oil and food prices are going to eat into disposable incomes, and consumers are going to spend less on other goods. So producers and retailers that want to protect their sales volumes are going to have to eventually reduce prices. So there is scope that even though food and oil will keep inflation up, that will be countered by lower inflation or deflation in other parts of the CPI basket.
And there were some upbeat points around this announcement, weren't there? I mean, if you look at GDP, she says 3.7 for this year, next year 3.9. So that was pretty upbeat, wasn't it?
That was definitely quite an upbeat outlook on growth. Much of it, of course, also depends on what happens internationally, and she was careful to outline those risks as well, with there's implications of the Eurozone sovereign debt crisis. Also in the US, even though she mentioned that the outlook was quite favorable, the housing market is very weak, and the recent figures have been disappointing. So there are still very big risks to the core economies, and that could be a drag on the domestic economy.
All right, having said all of this, there are still questions, and many people want to know, when will we start seeing the start of that rising cycle in the repo rate? Would it be next year, as some are saying, and the markets, I know, for example, are already factoring in the start of the interest rate upward movement come September this year? What do you think?
Well, we expect that, given the state of the domestic consumer and that inflation's likely to head towards the lower end of the CPI target, if the SARB doesn't cut again, then at least they'll definitely keep rates low well into next year.
There's also this other argument that perhaps we see some movement only when we start really moving outside of that 3 to 6% target band. Do you think that's a sensible argument, that the Reserve Bank will only start pushing the rates up once we either close to the end of that target band or outside?
Yes, I would agree with that. If inflation starts heading towards the 6% mark, the Reserve Bank, you can expect them to turn more hawkish and to prepare the market for a rate hike. And by the same token, if inflation were to breach the lower end of the inflation target, we could see another cut.
All right, she says the biggest risk, of course, to inflation is really this food and administered oil prices. We see the petrol price going up. We know that electricity is not easy on many people. What do you think this will do to households?
Well, as I have mentioned, because consumers are still under pressure, their finances, we're still seeing a lot of deleveraging, and there's a very weak appetite for taking on more credit. And given that state, higher oil, higher electricity prices, higher food prices are going to weigh on disposable incomes, and consumers are going to spend less on other goods. So I expect the South African consumer will take some strain against these higher prices.
In the previous MPC announcements, we've heard the issue of wage demands coming in. She's done it again. She's spoken about wage increases, but she did say it's moderating. What's your take?
Yes, they're moderating as inflation has been lower, and that would, of course, bode well for the employment outlook, which is something that she's mentioned, because with these cost pressures with higher oil, producers are going to struggle to push that on to consumers. So they're going to have to shoulder these higher costs. And if on top of that you've got to pay much higher salaries, you're going to push back as a producer by laying off staff. So if wage demands are moderating, that would certainly bode well for the longer-term employment outlook.
All right, that's where we're going to have to leave it. Camilla Golder from ETM, thanks very much indeed for your time.
Thank you very much.
Well, there you have it. Reserve Bank Governor Joel Marcus leaving the repo rate unchanged at 5.5%. And that's where we're going to have to leave it. Thanks very much indeed for your time. Take care.